Hello, ladies and gentlemen. My name is Praj Samant. I'm the Global Practice Group Leader of the Energy and Natural Resources Group here at Reed Smith. I'm based in London ordinarily. As China looks outward and as it increasingly flexes its diplomatic and cultural and political muscle in an extraterritorial way, it seems that we're in something of a pattern whereby the UK and the US are increasingly looking inwards. And that is an interesting development because they say that this is Asia's century. And given recent events in the UK and the US both, let's hope for all our sakes that that is the truth. Singapore is and has always been Asia's commodity and trading hub. And everyone wants to do business in China at the moment, but preferably they want to do it sitting in Singapore. Today, I'm very proud to present a panel which represents our strength across 4 of our 5 Asian offices in Singapore, in Hong Kong, in Beijing, and in Shanghai. Very gratifyingly, this is a seamless offering which works for many of our clients across the region. And I hope what you'll get today is an interesting, interactive, and informative seminar that explores some of the issues that you all face in your businesses daily. So with that, and without further ado, I'm going to pass over to the moderator, Simon Jones, my other partner in Singapore.
Hello, everyone. Thank you, Praj. As you say, I'm Simon Jones, and I'm going to start by giving you a brief overview of what we're going to cover today. So firstly, what do we mean by the Singapore-China Commodities Nexus? I'm just going to give you an introduction and an overview to that, and an introduction to some common transaction structures that we see and often work on involving clients in Singapore and in China. I'm then going to hand over to the panel moderated by Peter Zaman, who will dive into a bit more detail. But without further ado, what do we mean by the Singapore-China Commodities Nexus? I don't need to talk through the statistics, but Singapore is Asia's leading commodities trading hub. Pretty much everyone in this room is really testament to that fact. So I don't need to talk about it much more. China is obviously the world's largest destination market for commodities. And some of the sort of bread and butter stuff that we've been dealing with over the last several years that are examples of the links between Singapore and China include Singapore-based traders trading physical commodities with Chinese counterparties, structured transactions with Chinese counterparties, which might involve financing or prepayment, which might have both a physical and a derivative element. This includes transactions like repos, warehouse financing, prepayment, LC-backed transit trades, and similar sorts of structures. And this might involve a wide range of physical commodities and futures, metals, iron ore, oil products, coal, and agri-commodities. But why are we talking about this now? I'm sure a lot of you in the room have been dealing with those sorts of transactions. We certainly have over the last several years, and we'll continue to do so. But we have seen a trend of the nexus between Singapore and China evolving. And this really explains why we're talking about this now. So as margins on physical commodities are getting thinner, the margin on prices is getting thinner, there's an increased recognition of the need to lock in pricing by hedging on exchanges. And when dealing with Chinese counterparties, international players are looking to do that through using Chinese exchanges more and more. But in addition, to potentially exploit arbitrages that may exist between Chinese exchanges and international exchanges. And so, there is a current trend we're seeing of an expansion of international players looking to do more and more onshore Chinese business, mainly because of the fact that you can't access those onshore Chinese exchanges without an onshore presence. And so we're seeing people setting up or expanding the remit of their wholly foreign-owned enterprises, or WOFIs. We're seeing joint ventures, use of free trade zones. There's now 11 free trade zones in China, which includes 7 newer ones, and an increase in trading on Chinese commodity exchanges, including Dalian and the Shanghai Futures Exchange. And we're also seeing Chinese companies expanding internationally and using Singapore as their base for international trading. So we've seen examples of Chinese companies setting up their international trading base here. And, you know, in the LNG markets, we've seen it in coal and metals as well. And another reason we're talking about it now, it's topical, is the Belt and Road Initiative. Singapore is on the new maritime Silk Road, and we think we're going to see an increased demand for raw materials as a result, increased demand for access to commodities infrastructure, and for price risk management tools and local pricing of raw materials. So that's just a bit on the trend that we're seeing and why this is topical. But moving on to a few key transaction structures, starting with one that has been around for a while, and you may well have seen yourself. This is a repo or a sale and repurchase transaction, whereby commodities might be sold by a trader to a bank or other financing party who pays cash for that commodity, and at a date that's agreed in the future, the trader will then repurchase the commodity back, obviously paying the bank for it. And that allows the trader to monetize an asset that is just sat in storage. Might be in a warehouse, might be in a tank. This can be done on ship as well, so it's not necessarily just in store, but what we're talking about here is commodities that are in China. You know, they might be stored in China. You've got to have a storage agreement. That could be a tripartite agreement between the 3 parties. And some specific issues of Chinese law arise that you need to look at. You need to look at holding and transfer of title to commodities under Chinese law. You'll need to look at warehouse and storage issues. We all know about Qingdao and the warehousing fraud that occurred there, and other examples as well. And so there's lessons to be learnt that you need to consider in your storage arrangements in China. We could spend hours talking about that. It's not the focus today, but we can, of course, talk about it afterwards if you like to. You also, with a repo transaction, and we'll need to look specifically at the Chinese law on this issue, to consider whether or not this is going to be considered a true sale of the goods, or whether there's a possibility of it being reclassified as a financing transaction, and thereby potential consequences in any insolvency. So that's a repo. And moving on, Jessica is going to walk you through an example of a typical Chinese prepayment transaction.
Good afternoon, everyone. My name's Jessica Kenworthy, and I'm a trade and commodity finance partner based here in Singapore. So under Chinese prepayment, I'm going to go through a typical structure. Not all structures are exactly the same as this. And the reason why we're going through prepayments is it's probably the most prevalent structure that we're seeing in the market, particularly over the past 4 years. And under this structure, you tend to have a bank which provides funds to a trading entity, and that loan will either be on what's called a limited recourse basis, and that could be where the recourse to the trading entity to repay the bank for producer risk is limited, say 10 to 15%, for example. Or it could be what's called full recourse, so that could be where there's 100% recourse for producer risk to the trading entity under the loan. And generally in that kind of instance, the trading entity will get insurance cover for the producer risk. The trading entity, we've got one here in Singapore. It will then use the funds that it received under the loan agreement here to make an advance payment for goods under a sales contract. The seller will quite often be an entity within the producer group, which has been incorporated offshore in Hong Kong just as a trading entity to face off-takers and banks. The seller will use the funds it received under the advance payment here to make an advance payment for goods from the producer in China under a back-to-back supply contract here. And then the producer, once it's produced the goods, will then deliver under the contract to the seller in Hong Kong. The seller will then deliver to the trading entity in Singapore. And invariably, outside of the structure, you'd then have maybe an offshore third-party entity here, which could be an end buyer. Sometimes the producer, you won't physically deliver all the way along the chain. You'd actually just have the producer delivering directly to a third-party entity offshore. This third-party entity would then pay for the goods to the trading entity. It probably is required by the bank. If the trading entity isn't considered sufficiently creditworthy, it may be that the bank would request that this end buyer pays all amounts into an account held with the bank, for example, or the final offtake contract might be assigned to the bank. But the trading entity ostensibly uses all the funds that it's received from this entity to repay the loan here. And in terms of security and guarantees, what you'll quite often see is you'll see within the producer group, you'll see guarantees from either from a parent company or from the beneficial owners of the producer group. So that could be personal guarantees. And they tend to be given to the trading entity first. And there may be other forms of security like share pledges, for example. The lender will then require the trading entity to on-assign all of the guarantee proceeds and any of the security rights that they have from the producer package provided here. And that's all on-assigned to the bank. And in addition, what they'd probably require is also, to the extent possible, and I'll go on to that in a moment, security over the bank accounts, also over receivables, and to the extent that there's insurance, then insurance proceeds as well. So I'm now going to go through some of the key issues that you face with Chinese prepayments that you should be thinking about when you're structuring your transactions. So the first point to consider, and it's fairly fundamental, is whether or not the transaction as structured needs registration and approval with the State Administration of Foreign Exchange, or SAFE, as it's known generally. And under Chinese foreign exchange rules, there are certain transactions that do require this approval and registration procedure. And the panel are going to go into that in more detail later, so I won't mention it further now. Next, thinking about accounts, under Chinese law, there's no concept of a floating charge, and as such it's quite difficult to take security over accounts where you've got monies going in and out. You can take security over fixed term deposits, but it is possible, despite not being able to necessarily take security over funds going in and out of the account, you can take security over receivables. And so when you're putting together your security package, you should be going to your PRC counsel to get advice on how to create that security and any of the issues that you might face. And back onto the subject of accounts, in a typical prepayment where, say, you have a borrower that's onshore in China, you tend to have various different accounts that need to be set up. So you have a collection account for receipt of sales proceeds. You also have onshore debt service accounts and then offshore debt service accounts. And those onshore and offshore accounts basically enable to control the source of funding that may be coming from external sources, and also enabling the conversion from US dollars into RMB. You'll also then have an escrow agreement which will govern all the accounts and the mechanism and the, how you do the onshore offshore flow of funds. And again, the panel are going to go into all of the onshore offshore flows a bit later. So registration of security is an issue in China as well. So the general rule is if you've got an onshore entity providing security to an offshore entity, then it's very likely that the debt obligations, the foreign debt obligations and or the security may need registration in China. But there are also certain types of security documents that always need registration in China, with State Administration of Industry and Commerce, for example, and People's Bank of China. So always seek advice on registration of security when you're structuring your transactions. A further point to highlight on security is the fact that in China there's no such concept as an assignment by way of security like you would have under English, Singapore and Hong Kong law. And as such, you don't really tend to see from a Chinese entity an assignment of contracts, because it would be an outright assignment of all of the rights rather than just an assignment that's enforceable on a default. And the final point, which is going to be covered in quite a bit of detail during the panel session, but there's also an article in your packs about governing law and enforcement of rights in China. So it's always a good idea to get advice on what the governing law is of your contracts under the structure to ensure that you get the best possible position to ensure that you can enforce your rights in an enforcement scenario and default scenario in China against the producing entity in the group. Right, I'm going to hand back over to Simon for the next structure.
Thanks, Jessica. So we've obviously been through a physical repo, a Chinese sort of physical prepayment, which has more financing elements. Now focusing on a derivatives-related structure. There is this is just one example potentially of many, but there is potentially an arbitrage between LME prices and the Shanghai Futures Exchange prices, and the example here we're looking at is nickel futures, and parties are looking to exploit these sorts of arbitrages. And you might be a trading company with your Asia headquarters based here in Singapore. Support functions are here, your lawyers are here, a number of you in the room. But you might also have a woofie in China. And you need that onshore presence in order to trade on the Shanghai Futures Exchange. But then you can exploit the arbitrage between that and the LME price by potentially utilizing a PRC bank with its branch in the free trade zone that also has an offshore affiliate branch, which then is a clearing member of the LME. So this is a method by which players are seeking to exploit these arbitrages using more and more their onshore China presence. I'm not going to go into more detail than that at this stage because the panel are going to go into more detail on some of the China specific issues. And so I'll hand over to Peter, who is going to be moderating our esteemed panel.
You have in front of you the benefit of our colleagues from our resource law team in Singapore, our colleagues from Shanghai, Beijing, and from Hong Kong. When we decided we're not going to spend a lot of time introducing each other and what we do, in your pack you'll find the bios for all of your speakers. Please look at them at your leisure. Essentially what we would really want to do is just get on with it for you. Broadly speaking, we're going to try and cover a lot of ground in the recorded session for about 30-35 minutes, and then we're ideally going to leave another 30 minutes after that for the non-recorded portion under Chatham House rules. So I'm going to kick off by putting a question to Michael. Michael is the head of our Beijing office and has been doing this for probably longer than he wants to admit. One of the questions we often get, particularly from our clients here in Singapore, Michael, is how much can we do offshore? Do we have to be onshore? What are the pros? What are the cons? What are my choices? Michael, can I get your thoughts on that?
Sure. Thanks very much, Peter. And very happy to be in Singapore, actually a few degrees cooler than Beijing, although somewhat more humid. Yeah, it's a very fundamental question, sort of onshore or offshore. Offshore clients who are looking to trade with Chinese counterparts on the mainland can do so through bilateral trades for physical delivery of commodities. It's a relatively safe arrangement. Contracts can be governed by non-PRC law, with which the offshore client will be familiar. But I think when we're looking at whether or not the client should move onshore, we need to think about what does the client really want to achieve? What sort of scale of business does he want to aspire to? And as Jessica mentioned as well, do they actually need to be, and Simon as well, do they need to be onshore to access the local markets? So those are the primary considerations. It's a question of scale. But I would also say that that question of scale needs to be part of a well thought out business plan, which does more than actually just consider the potential size of the market. You have to be going into that market with your eyes open in terms of governing law, which we'll talk about, costs, and bringing yourselves under the regulatory framework of the PRC.
Catherine, once you're onshore, what are your choices? Do you have to be wholly owned? Do you have to set up partnership with people? How does it work?
Basically, if you decided to go so-called go onshore, then you have 3 choices options depending on the stage of your China market appetite. If you are very new and just simply as the first step, companies will choose to set up a representative office to get more market knowledge, to do the market research or liaison work, or raise the profile. But a rep office activities are limited to non-income generating business activities, so basically limited to market research, liaison work, and the raising your profile, the branding, that sort of thing. And then the second is, as the client getting better understanding of the China market, wants to step further, then you set up a real independent company, so mostly WOFE. WOFE is one option, and of course the other choice is joint venture, to join arms with local partner if you need it from the business perspective and also legal regulatory perspective. So because under Chinese legal regime, foreign investment regime, there are sectors that in which the foreign investment can only take in the form of joint venture. But in terms of commodity trading, generally that's not an issue. So that's why we've seen a lot of the trend is a lot of commodity trading companies are setting up their own WOFEs because it's easier to control and there's no partner to deal with. So it will save a lot of business issues, cooperation issues. So that's basically the...
And just to be clear, if you wanted to go down the joint venture route, there's no minority, majority shareholding issues?
If, as a commodity trading companies, no. If you can set up a whole WOFE, then you can own majority.
Yeah. Okay. So, Will, you're based out in Hong Kong, the go-to place for access to China. Has anything changed?
Well, thanks, Peter. I think it has. I mean, as everyone knows, it was an accident of geography and history that Hong Kong became the sort of premier trading hub and entrepot port. for China. It was the only or the last free port in China. But a combination of factors, sophistication in the mainland, a lack of interest by the Hong Kong government in developing Hong Kong as a trading hub and focusing on more things like equity capital markets, and much greater competition from places like Singapore has meant that Hong Kong isn't the premier trading hub for China anymore. But there are a couple of advantages, and the Closer Economic Partnership Agreement, CEPA as it's known, which for many years, it was put in place as a sort of free trade agreement between the mainland and Hong Kong, and for many years it was seen as being a largely pointless exercise. Occasionally, and it's been amended over a number of occasions, and we're now on CEPA 10, which is the 10th addendum to CEPA. Some opportunities have been spotted. A few years ago, not really relevant to this audience, people worked out that you could acquire a Hong Kong medical practice, and that would enable you to set up medical practices within the mainland. One area which we're quite interested in, though, is that Hong Kong brokerages, which are licensed by the Hong Kong regulator, the SFC, to do futures trading brokers and securities brokers, are also allowed now to set up mainland brokerages, licensed mainland brokerages. And that's actually created a secondary market in small mom-and-pop licensed brokerages in Hong Kong, where they may not be very successful, but they've got a license and they've got a track record. You have to have a 5-year track record. And so there's a trading of licensed people are acquiring these small businesses with the licensed persons as well. You've got key person provisions in these contracts, and then are using that to set up futures brokerages that will give for your derivatives transactions. You'll be able to give you direct access to the market through a broker. You wouldn't need to use someone else's local brokerage. But that's an area which is still somewhat under development, and I don't think it's been fully exploited yet.
Okay, so beyond CEPA, we've also seen transfer of opportunities between China and Hong Kong being led specifically, I guess, in the financial sector for institutional investors. So I'm thinking about QF1, RQF2. Those are essentially for a particular class of business. They don't have any application specifically in the commodities space. But what I find very interesting about them is that they are nonetheless an example of a sectoral opening up of the Chinese markets to offshore entities. Any chance we're going to see that directed at Hong Kong with a specific focus on commodities?
Very hard to say. You don't really get too much notice of a deal that's been done. But I think at the moment the focus, Hong Kong has very limited commodities regulation at the moment. We're not a G20 member, so we haven't put in place the level of regulation. And so the focus has really been on what the regulator knows, and futures rather than OTC derivatives, which you know is being regulated in Hong Kong, is not an area that CEPA or similar bilateral contracts discuss.
Thanks. So, Kohi, turning to you, I mean, there is something that looks a bit like CEPA between Singapore and China, the Singapore-China Free Trade Agreement.
Yes.
So, in your career as a lawyer working in Singapore, how often have you had to look at it?
Frankly, I must say no. I've not had a chance to. I have not been consulted on the ambit of CSFTA, but just listening to Will saying that how CEPA has gone through 10 rounds of amendments. CSFTA came into play in 2009, and to date, there's been no amendment. There's been talks, I think, since last year that there'll be an expanded role for the services sector in the CSFTA, but that's still not very much been implemented yet. But going back to the fact that I've not been consulted in the context of CSFTA, but I think it's also the nature of a free trade agreement to begin with. It deals with duties, tariffs, place of origin, source of origin, percentage of origin, which are more issues that were dealt with by accountants or tax law is not really my field, I would say.
Okay, so 10 turns of CEPA. We're yet to see the first turn of the Singapore-China Free Trade Agreement. So scope for opportunity there to sort of replicate opportunities like CEPA is creating for local market participants?
Possibly, but this obviously was raised in 2016 when the Singapore-China climate is slightly different. I think things will pick up again, but this may take a bit more time before the amendments will come into play.
Okay. So what does the treaty currently allow for? Let's focus a little bit on the services side, because we know the goods have been flowing back and forth quite regularly. But purely on a services side, what exactly can we rely on the treaty for?
I suppose you can look at the treaty for certain services that a Singapore-based company or an offshore company can rely on. Services like accountancy, taxation, management consultancy, recruitment, even to a certain extent legal services, financial services. These are all services that comes within the purview of the CSFTA and could potentially be used by a commodity company in terms of getting the right services.
Are they unrestricted?
There are certain limits. The starting point is it's meant to be it's meant to give a lot more opportunity for Singapore businesses to get involved in the services, but there are obviously certain restrictions on access as well as nationality, and depending on the type of services that's being offered.
I just pick up on something Will said, where SEPA was in fact not very often used until it suddenly became useful. And I just wonder whether or not that invites people to consider the opportunities that the CSFTA perhaps invites.
Yeah.
So I'm going to change track a little bit, and I'm going to ask Catherine the next questions. And by all means, should any of the other panelists wish to chip in on this question, by all means do. But when I first started working in the jurisdiction, one of the challenges I always had, coming from the Western perspective that I do have, is laws are often written down and you read the letter of the law and you try and understand what the law requires you to do, and then you get to the point where sometimes you have to rely on guidance from the regulator in order to work out what you can do. And then I, in my naive way, imagine that's how it works in China as well. But Catherine, maybe you can shed some light on why that may be a bit of a naive view.
Okay, so this goes back to the fundamental difference between the PRC legal system and the common law legal system like Singapore, Hong Kong, or English law. Because PRC legal system is based, roughly speaking, generally speaking, based on the civil law tradition, which means based on statutes. So everything, every law, the formal law are all in writing. So the written law, there are hundreds of laws actually, but most of the laws are principle-based. The lack of the details and very broadly drafted and vaguely drafted. So that's why you can come across a lot. Often it's just the notices from a ministry or commission or CSRC or NDRC. You come around notices or even official replies from the central government commission to their local counterparts. And those are the written, those are the real laws and rules that in operation. So you can get a lot of opinion or advice from PRC lawyers saying, in theory, that's based on the letters of law, it's like, but it's not clear for specific questions. But in practice, then you will cite the notices or replies, and even sometimes even those written notices or replies from the ministries levels are not clear on those issues. So you have to make the informal consultation, telephone consultations with the various regulators. So it's kind of very challenging. I mean, conceptually for lawyers from background from common law legal system education. So that's the fact we have to.
So you mentioned the laws are principle based. So does the fact that they're principle based therefore mean they don't give you a lot of color when it comes to working out the scope within which you can act and not act within the framework of the rules?
That's right, yeah, exactly that.
Okay, grey areas.
Yes, grey areas.
So, Michael, you've got grey areas, you've got a ton of acronyms that support the regulators, that support this market, I mean, CSRC, NDRC, SAIC, SAFE. All right, you get the hint. So how do these regulators and what they do fit into the world of what I call grey law? Perhaps you can enlighten us.
Okay. Well, with that, I mean, a lot of those acronyms have been thrown out, and I think, I mean, just in terms of the regulator that you'll probably come into contact with in your China operations, just to touch on, Jessica touched on already a few. We've talked about SAFE. SAIC really is the regulator that you'll go to with your application set up a WOFI. Now an online application. Formerly, it was an approval process led by MOFCOM, Ministry of Commerce, which is still the approval regulator for joint ventures. So SAIC is the registration entity for businesses, WOFIs, including joint ventures, to actually issue the business license. NDRC basically is responsible for directing the development of the economy. It can be regarded as a gatekeeper for external investment, along with MOFCOM in terms of setting up overseas entities, and also in some respects for some internal investment as well. In terms of actually going about understanding how to interpret the laws and dealing with the regulators, Catherine's already touched on the need to consult. Just a couple of things with the regulators, a couple of points on that. There is no concept of estoppel, so you may get some guidance from a person, and you typically want to target those who are charged with interpreting at an implementation level, relatively low level, the laws. You'll need to get their advice or guidance on certain areas, grey areas. But because there is no concept of estoppel, you can't cite that advice to say, well, look, and to be able to rely on it. So what you would do then, you need to obviously use your experience, use your legal advisor's experience in the market to try to evaluate how reliable that is. It may mean that you actually also consult a number of different personnel in the same regulator to try to get a consensus view. So it's quite a different approach to what we would see outside the PRC, where typically you would expect there to be sort of more of an official voice and more of a defined position. And of course, not only do you have those difficulties, you also have different interpretations on a regional basis as well as according to regulator.
So you've got centralized problems, centralized messages, then the regional variation on that.
Exactly.
Okay. So when you get the call at 5 o'clock on a Friday afternoon, your reaction to that is?
Well, wait until Monday.
Very good. All right. So we've heard Jessica mention safe rules, Simon's mentioned safe rules, I think, as well. You brought it up just now. SAFE comes up a lot because we essentially find that the flow of capital in and out of China is very heavily regulated. So from a transactional basis, Jeffrey, can I ask you to share some thoughts on this? Where are you seeing the transactional challenges, and how do they fit within the SAFE regulations? Perhaps you could give us a bit more color. I think you've had the privilege of having to face regulatory investigations as well from SAFE, so I'm sure you can draw on some of that.
Sure. Jessica's presentation just now on the prepayment transactions has already mentioned the role of Chinese companies in a typical trade finance transaction. And we are increasingly see that in such transactions, sometimes the whole transaction is secured just by security provided by the Chinese parties. It can be in the form of a parent company guarantee provided by the parent company. It can be in the form of a personal guarantee provided by the owner of the business. It can also be in the form of a share charge, which is the parent company charge the shares of a subsidiary to guarantee the transaction. All such very likely such a security needs to be registered with SAFE. Okay. The issue we need to consider is that such registration is quite different from the sort of registration you are familiar with here in Singapore or in Hong Kong or in London. First, I want to mention that is that the entire registration regime has actually already improved in a great deal. Before 2014, before 3 years ago, it was actually an approval requirement, which means the perfection of a guarantee requires approval from Chinese authorities. So since 2014, actually it has already been relaxed. It's now officially a registration. That means the Chinese authorities should not examine the substance of the security agreement you are going to register. However, it still is not the same as those registrations here in Singapore. In two aspects. One is there are some prescribed requirements from SAFE you must comply with. Will affect on the typical English law or New York law government documents. I just use one example. For example, if you want to register a guarantee with SAFE, SAFE will require you specify the maximum liability under the guarantee. Okay, but we don't have that under standard English law government guarantee, because under English law guarantee you basically say we guarantee all the liabilities. Anything you are unable to fulfill, I guarantee it. There is no fixed amount. But if you want to register this guarantee, SAFE say, tell me what's the maximum liability. Okay. There's a reason for it. It's not unreasonable. The reason is that because the SAFE's function, its mandate, is to oversee the flow of funds in and outside of China. So a guarantee from a China perspective is a potential liability. If a guarantee is being enforced, so if the guarantee has a guaranteed amount of $100 million, if it's not enforced, fine, no problem. But it is enforced, that means potentially at some point in the future, there will be a $100 million US. It will go out of China. So SAFE needs to know, under this guarantee, what is potentially, how much money will likely or potentially it's possible to go out of China. So they will have this requirement. They have their reasons, but the thing is that such mandatory requirements will have impact on those standard documents we're familiar with. So this is one thing we need to bear in mind. So it's not such as simple say, okay, this is typical English law government guarantee. Okay, we just give it to the Chinese counterparty, say, just sign it, done. No, that's going to be issues. The second issue is that although it's called a registration, it's still a quite labor-intensive process. I remember 3 years ago, I done a transaction which involves perfection of security in Singapore, Hong Kong, and mainland China. I remember that at that time, in Singapore, it's very easy. It can be done online, literally within half an hour, done. Hong Kong is a little bit, Hong Kong, you actually need to go to the company register, submit the form. But still, it's a very predictable process. China, one is you need to, it's a labor intensive, it can't be done online. You will need to register with the local branch of the SAFE. Okay, the geographical is an issue because the local branch of the SAFE means it can be anywhere in China. You may have I think we have a transaction as far as Xinjiang province, which is, say, 4-hour flights from Shanghai. So it's not like here, if you do a registration in Hong Kong, you go down to the company register. But in China, potentially, you need to fly several hours to go to the place you can register. And second is, you need to provide a lot of supporting documents. It's labor intensive. The second is the time. It can take, on average, 3 to 4 weeks to complete a registration. And this will affect the timeline on the transaction. Often we see in a transaction that the party signed the contract, signed the financing document, and the borrower gave an enormous amount of the pressure on drawdown. But typically, one of the CP is that you need to complete the registration with the Chinese authorities. And that can take 3 to 4 weeks. And people may not expect that. So we need to take into these considerations to say we need to be aware of the impact on the insular government documents. We need to aware of the impact on the timeline on our transaction. And we also need to impact on the workload and the cost of the transaction.
So from our perspective, it's about managing expectations partially, I guess. But I guess you've also explained why there are so many budget airlines in China carrying lawyers back and forth. So thanks for that. Catherine, you've set up your WFI, you're doing well. How are you going to get your money up?
The typical, the routine route would be the dividend payout. But recently, we have all read stories that the foreign investor companies are experiencing difficulty in getting their dividend payment out of China. And the official line of the SAFE saying, oh, we didn't change the policy. It's just we always stick to the authentication. If you can prove that this dividend is legitimate payment, legitimate lawful compliant with the SAFE rules, then you are okay. We don't do that. But in fact, and later on in the beginning of this year, so they finally issued some written notice, say requesting additional documents to support the dividend payout. Previously, there are less documentation requirements to support the payment of dividends back to the foreign parents. So that, again, like Jeffrey mentioned, that this SAFE policy is mainly a policy issue, and then the policy will shift from time to time depending on RMB's devaluation, depreciation or appreciation against US dollars and the PRC's foreign exchange reserve, the amount of that, because under the PRC foreign exchange control regime, the SAFE is trying to strike a balance of the inflow of foreign exchange and outflow of foreign exchange. A couple of years ago, when the PRC RMB appreciates a lot and the PRC asset bubble goes up, so a lot of so-called hot money coming into China. Back then, SAFE's task is to prevent hot money coming into China. So, so they're not imposing such strict conditions to foreign exchange go out of China. But now the time changes because now RMB is facing great pressure of depreciation. So the Chinese government is worried about the capital outflow. So that's why under the current policy, they require the banks to have more strict scrutiny over the outflowing of funds.
So let me see if I understood this correctly. You have a change in policy as a result of which they become more strict, but it doesn't amount to the introduction of new laws, because as Jeffrey says, there's probably laws in plenty of volume out there already.
Yeah.
It's just a matter of what, enforcing them?
Yes, enforcing them.
Okay.
And orders or so-called window guidances to the banks who are handling this processing the payments or receive of the foreign exchange. So all through the banks.
So window guidance, that's a new one on me. Tell me a little bit about window guidance.
So it's called window guidance is exactly because they are not in writing. So there are no rules, laws, or notices, or even replies in writing. And oftentimes, if you call the SAFE to verify whether it exists, they will say no. But the banks, the folks in banks that know say that, yeah, we heard, we received the telephone call, that sort of. So the call we receive, banks will tell us that we receive window guidances that we have to heighten the scrutiny over certain either inbound inflow or outflow of funds. So that changes from time to time. Yeah.
Okay.
Okay, can I add a few things
Please.
On this point? Getting profits out of China was a very hot topic early this year or late last year, because you may have read from a newspaper from the medium that those foreign invested companies, they complain that suddenly they find it's very difficult to remit the profits out of China, not as easy as it used to be. However, SAFE, the State Administration of Industry, Foreign Exchange, quickly came out to clarify 2 points, which I think are real. First, there's no change in law in terms of getting profits out of China. There's no change in law and regulation. This is first. Second, even from a policy level, it's not the goal of the state to prevent the foreign investor companies to getting their profits out of China. But then you ask why we still see those negative reports in the media. My think is this, because you have all read, I think last year China has suffered a great decline in the foreign reserves. So I think since I think the middle of last year, the Chinese government fund, I think it's a very big problem. So it become a political task to try to stop this, stop the rapid decline of the foreign reserve. So I think in China it's like this. Once you have this policy from the central government, at the local level, from the local government to all the bureaus, to all the ministry, they will have the political task to implement this policy. So this makes banks ask this is the same to the banks. The banks have the order from the government to say you should do something to stop this, and they will be appraised because, I mean, how much money, whether a bank has a balance in the money come in and come out, so they will be appraised as a target. So each bank has a target. So under this background, the bank has tightened the procedures for getting the money out of China. I think the procedure is still the same, but the difference is that in the past it was quite relaxed, but now they suddenly have the strictly to enforce the procedure and make it more difficult.
I'm conscious that we're maybe scaring people away from their China investments. You know, so, but basically, this implementation, policy implementation, is more an exception to the capital account, current account transaction rules. But that basically, current account transactions are without significant control. So we must put it in context. I think that's what we're trying to do here. I don't think it, as I said, there's no fundamental change in law, but it does, it serves to highlight some of the challenges in doing business in the mainland.
And also, I personally believe the official line of the Chinese government is real. The official line is that we're not targeting the profits, to be remitted to overseas by this foreign investor company. The reason because that this is only a very small part of the foreign reserve that China is losing. Actually, China has taken other measures in other aspects to stop the outflow of funds. I think the most severely affected area is actually outbound Chinese investment. Yeah. I think last year, the outbound Chinese investment has hit a record. A history record, but this year we have seen a quite sharp decline by outbound for the outbound investment by Chinese company, because the Chinese company has identified this is actually possibly the biggest area that China is losing its foreign exchange.
So yeah. I'm going to change tact again now. Catherine, a lot of people want to get on Chinese exchanges. Mm-hmm. They've got a lot of liquidity. What's the secret? Why are they so successful? Why does everybody want to get on them?
The reason, I think, first of all, economics, because China is the largest consumer for the raw materials, metals and iron ore consumers and end users, and also China is one of the largest producers of that. So naturally, economically speaking, that becomes the local players will trade in order to manage the price fluctuation risks, lock up the price, and another reason is China, the futures markets, exchanges, they allow individual retail investors on that. So a lot of individual retail investors on that market is doing the speculative trading just to make money like in the stock market. So that's why you've seen the trading volume is quite high. But in terms of pricing power, so-called pricing power, the local market is still local market. It has not yet become a market that determine the international prices for the commodities. But the Chinese government has already expressed their wishes to increase this pricing power of the local futures exchanges markets, and also to improve the investors' composition to attract more institutional investors. So to avoid overly speculative behaviors, to protect, to deepen the market.
Okay. So Michael, here we are. Terms are governed by local law. Terms are governed by foreign law. If it is local law, what does that really mean for somebody who's now having to deal with foreign law, domestic law contracts?
Right. Well, very, very simply, I mean, in terms of the use of PRC law versus non-PRC law, you may not have the luxury of deciding to use non-PRC law. I would generally advise clients to stick with what they are familiar with: Singapore law, Hong Kong law, English law governed contracts when they are offshore and contracting on a bilateral basis. When you go onshore and you have a WFI, for example, which is for this purpose considered to be a domestic entity, when it contracts with other domestic entities, that contract is going to have to be PRC law governed. So your room for maneuver there is very limited. And of course, what follows from that is also your dispute resolution provisions will also be dictated by that governing law. And I know Will has a lot of experience in that.
We sometimes see issues. I'm by trade a litigator, arbitration disputes lawyer, and a problem for a client, very often a new client, will arise in their China operations with their WFI that's got a contract with a domestic PRC company, a state-owned enterprise or privately held company, and they'll have put together the contract offshore, New York law, Hong Kong arbitration, and the first thing you say to them is, well, it's not valid under Chinese law. So Chinese entities can only contract under Chinese law. Chinese entities can only agree to resolve their disputes in China. And so unless you've got assets offshore, your Hong Kong arbitration award is going to be worthless. It's going to be unenforceable onshore. So the starting point in a dispute such as that, there's probably no point in going to arbitration in Hong Kong. You're going to have to resolve your dispute in the local court. You might as well get on with it in the local court rather than go through an expensive arbitration offshore and come onshore with your award. So the key thing to remember is you're not getting any advantage by agreeing foreign law, foreign dispute resolution if you are a WFI dealing with a Chinese party. You've got to go onshore. And if you're going onshore, go for arbitration, go for CTAC arbitration, not be stuck in the local court, because it'll be the local court of your counterparty, no doubt, who will have far more influence than you will. And the proceedings run rather different way when someone has local home advantage.
So CTAC arbitration enforceable in China?
Yes. Yeah. I mean, it's the, I'd say, the premier dispute arbitration resolution body in China, and the advantage of having onshore arbitration, one of the the few advantages is that you can get pre-arbitration attachments through the Chinese courts, so you can get security for your claim, which you can't get in aid of foreign arbitration or foreign court.
So you get a lovely judgment in RMB, which you've enforced, you've recovered. Jeffrey, does SAFE allow you to get those RMB judgment awards out of the country?
Well, that come back to the registration requirement. I think the very purpose, I think there are 2 points here. I think when people often ask me, I mean, if I don't register, it's going to affect the validity of the agreement. The answer is no. Technically, the registration or not will not affect the validity of the agreement. But what's the purpose of registration? I think it's come back to this, just as Peter mentioned. Okay, you have a guarantee. At the end of the day, you have a dispute, and you enforce a guarantee. You get the money in RMB, and you want to take the money out of China. At that point, the banks will say, we must see the registration with SAFE. And if you have registered with SAFE, the bank can process the payment directly. If you don't have registration and you have a problem getting the money out of China.
The other thing to bear in mind is that if you've got a contract and a woofie at a Chinese party, it's probably a renminbi contract anyway. So you're not going to be able to get the money out in hard currency.
So, thank you everyone for turning up in such numbers. You know, you're taking a lot of time out of your day, and we really do appreciate you spending as much time with us as you are today.